Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
This Saturday is going to be a very interesting one as we bring to you 3 knowledge-packed webinars and 1 direct workshop which we have lined up for you. In a market like this, if you're worried about what's happening to your portfolio, the 10 a.m. webinar is for you. Join us as we speak about how market fluctuations impact your investments, hosted by Harshil and Rham. As an extension, at 11 a.m., we break it down further on how market dips affect your SIPs and what you can do to not let the noise shake your goals. This webinar will be hosted by Harshil and Aishwarya. We have 2 Women's Day specials. At 4 p.m., we have a webinar on how to simplify investing for women using multi-asset investing. If you want to understand a stress-free and holistic approach to investing, please join us for this webinar. It will be hosted by our principal fixed income strategist, Samyuktha. We have another special direct workshop exclusively for women, which will discuss whether the 5K or 10K SIP route is better to reach your first milestone. We hope you can make it to the one that interests you the most. You can register using the link in the description below.
Welcome to the March 2025 edition of the Fixed Income Outlook. This month we're going to be talking about how big is the opportunity in fixed income. If we look at how investors are positioned today, a lot of them are trying to take a breather from equities because markets have been quite unpredictable and brutal in the last couple of months. So March is the season where investors seem to be looking towards other investment options outside of equity markets, something that could give them a little bit more stability and predictability. So in this outlook, we're actually going to break down what this opportunity looks like, and we'll start with the first point, which is that investors' risk appetites have actually changed. Now, what does this actually mean? Many investors have entered the markets in the last 4 to 5 years, which means what they've actually seen is a very non-representative way of how equity markets work. So their expectations have been quite different from what they should be, in the sense that a new investor has only seen markets move upwards, which has encouraged them to participate more, and they've bought into this mentality of buying the dip, which means every time they've seen the market correct a little bit, they've participated and scaled up their investments. But what they're seeing in January and February of 2025 is that this isn't a dip, but more or less a steep sort of decline that has happened, and there's no bounce back, which is what they were used to in the past. So this has basically brought a lot of investors back to the table and made them realize that seeing these kind of drawdowns, whether it's 10%, 15%, 20% or longer in their portfolios, is not something that they were mentally prepared for. It's not something that they were comfortable dealing with. So in a down market, a lot of investors come to terms with their true risk appetite, which is often different from what their risk appetite was when they started a particular investment. This has a lot to do with the kind of expectations that you had when you're coming in and the experiences that you've had while you've started your investments. So when these experiences as well as expectations change, there is a potential for you to revise your risk appetite, and typically in a down market, many investors realize that they'd like to be less aggressive, that they would like to tone down the levels of risk in their portfolios. So when they come to this realization, fixed income becomes a great asset to help them reduce or lower the overall risk in their portfolios. So that's the first point. The second point that we're going to talk about is that actually in this cycle, opportunity knocked twice. What do we mean by that? If we look at where we are in the market cycle, last year we were at peak interest rates because you had your interest rates move up and they were stable for quite a long time. And this year in February, we've had our first rate cut. Now, typically what you would see when a rate cut happens is that you would have some rallying in bond prices, which means bond prices would go up with the expectation of lower interest rates going forward. But most investors have actually not seen that rally happen. simply because liquidity in the market has actually been quite tight. And because liquidity has been tight, the yields have been still quite attractive, and investors who missed the opportunity so far are still getting something quite attractive on their plates today. So even if we enter into a rate cut cycle, investors have some time where they can participate. Particularly, liquidity tends to be tight in March because of all the advance tax payments and other things that might push yields up. So this is a neat window for investors to really take advantage of. This brings us to point number 3, which is the long-term macro picture. On the India side, this looks pretty stable, and I'm just going to look at 3 different parameters. So if we look at inflation, inflation has been consistently moving down over the last few months after peaking off towards the end of 2024. So this steady movement to bringing inflation into a more neutral territory has actually been quite positive, and all of the volatility that we had in food prices is coming down steadily. Now, could inflation pick up again later in the year? That's a function of monsoons and many other factors, but for now it looks like we're on the right path as far as inflation is concerned. Then let's look at growth. If we look at growth, here, of course, if we've seen how the RBI sort of toned down and revised expectations over the last few meetings, you are seeing a lower level of growth in FY 24-25 as well as 25-26 than say a year ago or 2 years ago in terms of what we projected for these 2 years. However, are we at a slow growth rate? The answer is no. We are definitely slower than before, but we're not slowing down. India still remains to be one of the top fastest growing economies in the world, and that looks like it's more of a long-term trend. Now, the third thing that we're going to look at is government finances, because this influences bond yields quite a bit. And if we look at where we are in terms of government borrowings, we've been on a very good path to consolidate our fiscal deficit over the last few years, especially post-COVID, and our fiscal management has been really good. At the same time, we had news coming in where rating agencies had not revised their India ratings in quite a while, whereas a lot of macro changes have occurred which are more long-term and structural in nature, which might warrant a re-rating to a better level. Keeping all of this in mind, I think overall the long-term macro picture still looks very good for India, and that could be a positive for bond market investors. And coming to our last point, in this market, there is a temptation to chase the returns, especially because one part of our portfolios are really not performing on the return aspect. So when we look at another asset class, we need to be very careful in what we expect out of that second asset class. When it comes to fixed income, the only advice to any investor is to seek safety and not returns. If you're seeking safety, you're going to get what you need out of the asset class. You're going to be able to do what is necessary, and it's going to give you that cushion to participate in the future, build confidence in your portfolio, and keep your investment stable in an unstable market. So we hope you enjoyed this outlook. And if you have any thoughts to share, you can let us know in the comments below. If you know someone who would enjoy this video, please share this with your friends.